Hello everybody, welcome to episode 5 of M&A Demystified. In the previous episode, we talked about a key valuation technique called comparable company analysis. In this episode, we are going to talk about two other key valuation techniques used in M&A, which are comparable transaction analysis and discounted cash flow analysis. So let's get started. In a comparable transaction analysis, as the name suggests, we look for similar transactions in recent history and use those to arrive at the valuation of our target. While no two transactions are similar, we start with identifying transactions in a similar industry, size, and geographic location of that of the target. Also, while we tend to look at transactions in the recent 1 to 3 year time frame, since transaction prices are very much dependent on economic and market situations, we may need to exclude years like 2020, where COVID has depressed the values of companies in certain sectors. Apart from this, there are two key things to consider during a comparable transaction analysis. One, a premium paid. Number two, sale conditions. So let's talk about premium first. Why is a premium paid during a transaction? A premium is typically paid in a transaction for two reasons. One, synergies. Number two, control. What is a synergy? Synergy is the additional value that is created when two companies are combined. This could be either in the form of cost savings or enhanced revenue opportunities. For example, when you combine two companies with similar products and services in a similar geographic area, there is a possibility of combining the operations, reducing redundancies, and thereby achieving certain cost savings for the combined company. And if the products and services are different, there is an opportunity to cross-sell to each other's customers, thereby enhancing the revenue for the combined company. This additional value created, either through cost savings or increased revenue, is referred to as synergy, and premium is a way in which the buyer shares some of that value with the seller. Also, in some cases, such as taking a public company private, there is a premium paid for control. The assumption here is that having control enables faster business decisions and executing them better, and as such, there is a higher value generated, and some of that is shared with the seller. So it is important to understand the various premiums that might have been paid in the comparable transactions and see if they are relevant for your target. While this information may not be readily obtainable, some press releases do talk about the cost savings assumed or revenue synergies that are expected in a transaction, which could give some hints about the premiums involved. Also, generally, strategic buyers tend to pay higher premiums than financial buyers. Financial buyers, however, have the capacity to pay all cash and are interested in sectors that may be a little out of favor and as such have their own advantages. Apart from understanding the premiums and the strategic rationale of the transactions, we also need to try to understand the sale conditions to see if it was a distressed sale where the company is being sold for a liquidation value, or if there was a competitive bidding where competitors have outbid each other, or if it was through a proprietary channel where the pricing may have been more reasonable. Understanding this would help us narrow down the transactions to the most relevant ones and also maybe to normalize the valuation multiple. In this manner, we would try to identify 5 to 10 comparable transactions. The sources could be press releases or investor presentations if it's a public company, or databases such as Bloomberg, Capital IQ, FactSet, Merger Market, or Reuters if it's a private company. Once the relevant transactions are identified, then you calculate the valuation multiples by dividing the transaction price by either revenue or earnings of those targets to arrive at the revenue and earnings multiples. Then you select a valuation multiple from these comparable transactions by comparing the growth, profitability, and risk of your target with that of the comparable targets if that information is available. If not, select a median or a first quartile multiple and use that to multiply with the revenue and earnings of your target to get to the valuation of your target. Both comparable company and comparable transaction analyses are referred to as market approaches, as they are based on information available about other companies and transactions in the market. Next, we are going to talk about an intrinsic valuation method or an income approach known as discounted cash flow analysis. Discounted cash flow analysis, or referred to as DCF analysis, is the granddaddy of all valuation techniques, and if you have ever taken a finance course, you must have definitely heard of it. DCF analysis is a huge topic, and there are a lot of resources available out there, so I'm going to focus here briefly on three key assumptions used in the analysis. One, free cash flows, which is nothing but the cash flows from operations after accounting for changes in working capital and reduction for capital expenditures. Number two, long-term growth rate, which is the growth rate assumed once the company reaches a stable or mature state and is used in the terminal value calculation. And number three, cost of capital or discount rate, which is nothing but the rate of return that you expect from the company that is commensurate with the risk associated with it. While this analysis provides a lot of flexibility, given the amount of detail and the assumptions used, it requires a certain level of experience and expertise to perform this. For example, discount rate could range anywhere from 10% for mature companies all the way to 50 to 75% for startups which may not have a product yet. While there are certain techniques and accepted guidance that are used in the estimation of discount rates, there is still room for uncertainty. This is where sensitivity analysis play a huge role. Sensitivity analysis is nothing but changing certain key inputs to see how the outcome is impacted. For example, you estimated the discount rate of a company to be 15%. But there are several inputs that go into it, such as company's capital structure, beta, etc. So it would be important to see how a change in the discount rate would impact the value of the company. So you would look at the value of the company if the discount rate is 13% or 14% or maybe even 16 or 17%. This analysis is what is referred to as sensitivity analysis and becomes a key component of DCF. So we've talked about three key valuation techniques, and there are a few others too. But whenever you're valuing a company, it is important to use at least two valuation approaches and reconcile the value between the two. If the value from these approaches are far apart, then you need to take a relook at the assumptions and adjust them. This will help to keep your assumptions in check as well as validate them. To learn more about valuation techniques, please refer to the blog of Ashwath Damodaran, a professor at Stern School of Business, NYU, who is considered by many in the finance industry as the authority on valuation. That concludes today's episode. Thanks so much for tuning in, and have a great week till we meet next.